Hello and welcome to Business Standard. I am Ankur Bharadwaj. The Union Budget 2026-27 is framed as a roadmap for India's next phase of growth, with a strong emphasis on infrastructure spending, manufacturing self-reliance, services-led employment, fiscal stability, and ease of living. It also reflects how the government sees India's place in a changing global economy marked by trade disruptions and geopolitical uncertainty. How credible is this roadmap? Where are the risks? And what does it mean for businesses, investors, and households? Those are precisely the questions Business Standard editor Shailesh Dobhal now takes up in conversation with editorial director A.K. Bhattacharya.
Thank you, Ankur, and good afternoon, viewers. Welcome to this special show on Budget 2026 on the Business Standard website. Union Finance Minister Mrs. Nirmala Sitharaman presented her 9th consecutive budget, including an interim one in 2024, and a third for the third term of the Narendra Modi-led NDA government today. Broadly, the challenges and expectations from this budget can be broken up in 4 parts. First is the immediate challenge of arresting capital outflows on account of foreign portfolio investors taking out $18 billion in 2025 and bleeding continuing in the first month of 2026. Even net foreign direct investments remains anemic. So what has the budget done to invite back capital flows? 2, the process of continuing past few years focus on fiscal consolidation and public investments. Thirdly, whether the finance minister has done enough to address some of the long-running pain points like lack of private sector investments. And fourth and the last, has the government given the roadmap how it will usher in the much-needed deregulation and what the Prime Minister says the reforms express to put the economy into the fast lane in order to achieve the developed country status by 2047. To discuss how far this budget has done on each of these 4 broad parameters, we have with us Mr. A.K. Bhattacharya, Editorial Director of Business Standard. Welcome, AKB, to the show.
Thank you, Shailesh, for having me here.
AKB, if I were to say that the Economic Survey did a redefinition of Swadeshi in terms of strategic resilience and strategic indispensability, and that was the big message of the Economic Survey, tabled on Thursday. Do you agree the broad focus of this budget is services? And why I say that is, there's a high level of banking committee that has been set up. There's a full standing committee on education and employment. The FM has spoken about university towns, the orange economy, medical tourism hub, India making India a medical tourism hub, India being a global hub of biopharma. She even gave a number that 10% of global services exports should be coming from India in the years going forward. And something that is also reflecting on our new FTAs, where the EU FTA, there were 144 subsectors of services that were opened up. So is this a services budget?
Well, I think you have described the budget in a very nice and cute way. As you rightly pointed out, there have been many highlights of the way the government wishes to capture the potential of the services economy. Of course, a 10% target is a very ambitious target. Currently, India's share in global services exports is only about 4.3% or so. So it will require a lot of effort on our part to really go up there to achieve the target. But our targets are supposed to be ambitious. So as a budget, I think the focus on services sector is well taken. But is it only about the services sector? I don't think so. I think there are elements in this budget that tell us how the government is concerned and focused on a wide range of other sectors like manufacturing. Look at the way the MSME sector has been given a lot of attention, in a sense, in terms of policy package for the MSME, the financial allocations, the credit supply delivery system that is there. Then there is, I cannot recall which recent budget would talk about creating a score of national waterways. The idea of a dedicated freight corridor has been revived once again after several years. There is ship repair idea that has been mooted, development of cities. So these are all, in my view, a focus on not just on services, but also on manufacturing and infrastructure, which is why I feel, Sailesh, that this budget, in many ways, unlike most other budgets, an extension of what we read in the pre-budget economic survey 2 days ago. The spirit of the economic survey seems to have been extended to this budget document, and it seems to focus on services. It seems to focus also on manufacturing and underlining the importance of providing them support and yet giving them selective competition.
Thanks, AKB. That was very succinctly put. And perhaps the number of capital expenditure of 12.2 trillion, perhaps for the first time, is more than the net market borrowings of the government at 11.7 trillion. Is there any bigger message that we can read there?
Yes, I think when your total capital expenditure is more than your net
market borrowings.
It tells you something, but please remember this net market borrowing is not the total borrowing that the government relies on, in a sense that the government is paying back about 5 lakh crore or so of old loans.
Yeah.
And also this market borrowing probably is not telling you also about the increasing reliance on small savings. So I think, yes, capital expenditure is an important element in this budget. After seeing a very tepid growth in the current financial year of around less than 5% growth in the current financial year, once again we see that the capital expenditure plan is seeing a growth in double digits. Now, more important in the capital expenditure number is the allocation that is being sought to be made for this sector. Now, normally what we see in the last 3 or 4 years is that the state's share in this capital expenditure has been rising. Now, sometime around 21, 22, this share of interest-free loans going to the states by way of Capex used to be something around 3% or so. In the current financial year, which is ending in a few weeks, it had gone up to 13%. And for next year, the share of states in this Capex will go up to 15%. So in other words, the center is riding increasingly more and more on the state's ability to absorb that expenditure instead of relying on its own ministries and public sector undertakings. As a matter of fact, the share of public sector undertakings, Capex and loans, which is a part of the Capex, is actually coming down. In other words, the center is spending little more money through its ministries and more money through the states. So it's the overall picture on the Capex is positive, but the composition of this Capex is also very, very interesting.
No, that's a very important point. But do you think the center's capacity to spend on investments is reaching a ceiling, 12.2 lakh crore now, which is...
Yes. I mean, the reason why the center is relying more on states is also a reflection of it recognizing its limits of its absorptive capacity. I mean, there was a time when 100% of the Capex would be spent by the center on its own road, railways, telecommunications, infrastructure sector, etc., etc. But now, as I said, that next year, as much as 15% of that, which is around 1.8 lakh crore, would be spent through the states. So the center realizes that it cannot go on raising Capex by 20%, 30%, which is what it did in the post-COVID years. But now it has come down to 10%, 12%. And as I said, in the current year, it is only about 5%.
I come back to the first point. Do you think this budget has delivered enough on attracting foreign capital? Because we are a capital deficient country. Our services surplus is not able to make up the deficit in merchandise trade, plus the reinvestments. So do you think this budget has done enough for invite more capital, both the portfolio capital and the strategic capital?
Yes, some signs have been sent, in a sense, in a limited way. I would say declaring a tax holiday for investment in cloud services. mainly the data centers, is an indication that the government wishes to invite more investment in the country. Some signaling is there. That signaling could also be seen as India's approach to various countries and making the trade agreements little more attractive, so to say. But I think on attracting more foreign investment, I don't think the budget has pushed that envelope very much, except this services sector initiative.
Coming back to the stock market specific measures, STT has been increased in future and options, which is a clear negative. But capital gains on buybacks is thought to be a net positive. Only for the promoters it remains status quo. For individual investors it's a positive. But the market hasn't really enthused by this budget.
Well, I'm not surprised at all by that response because the promoters who were shying away from sharing their gains with the ordinary shareholders through dividends were going through the buyback route. So the government is clearly trying to plug that route, and the market cannot be enthused because, after all, the promoters will be affected. But on the other question about STT, you will probably remember that some time ago, the Securities and Exchange Board of India had raised a bit of an alarm over the manner in which on futures and options were increasing at a rapid pace, and it was causing some concern. So therefore, I think this STT, remember this STT is only on future and options, not for other listed equity or debt transactions. So therefore, it is an attempt at curbing speculative activity in futures and options so that there's some sort of a check that is applied on this area, this segment of investment.
Would you think the markets would behave differently to the budget going forward? And there are two reasons that I say. You mentioned the tax holiday on data centers that has been given to foreigners up to 2047. Two, there have been a safe harbor rules changes in the IT sector that has been incorporated, which is going to benefit lots of GCCs. And one of the criticisms of the Indian stock market has been that why it missed the global rally was that there was no AI play. Do you think this will bring in the tech and the AI play into Indian markets, which was missing for the last 2-3 years?
I couldn't agree with you more on this. Yes, it will have a positive impact on such investments and the sentiment. Certainly, IT services is an important segment in the Indian economy. The GCCs, right now there are 1,600 or 1,800 and there are clear estimates that this number can go up to maybe 3,000 or 3,500 if sufficient conditions are created here. So I think this is one way of making India a more hospitable center for locating these centers. But has enough been done on this? I think the jury is out on that.
I'll come back to government revenues. The tax revenues have not punched at the expectations that they were supposed to. In fact, tax as percentage of GDP at 11.2 is among one of the lowest in recent years. Do you think the budget measures address this concern on revenue growth, the government revenue growth?
I think there is a lack of clarity on this front. You are right. The projection for next year on gross tax collections is around 11.2% of GDP. Now remember, the projection is based on a nominal growth of 10%. Now in the current year, your nominal growth of the economy was 8%, and yet the tax to GDP ratio was around 11.4%. Now, on a lower nominal growth, you are having growth of a GDP ratio of 11.4%, and on a higher nominal growth of 10%, you are projecting tax to GDP ratio of 11.2%. So I'm a little puzzled and confused that why is it a sign of conservatism that probably there is an upside benefit that has been built into these numbers. These are conservative numbers. Actually, she will, like in some of the years, 3 years ago, she would surprise you on the positive. My sense is that these numbers for next year are a little bit conservative, but who knows? I think the government is gearing up for unknown uncertainties that may emerge in this world of global risks and uncertainties.
True, true. On both the part B of the budget, the both direct and the indirect tax, there have been very many small changes that collectively add to a huge ease of doing business or living. Do you agree there?
Yeah, I think largely what has happened is that many of the changes were done in the last budget of tax rate changes, particularly for individual income tax. Now, as a result of which, I think tax rates going down meant lower collections in the current year also for the individual income tax. It is only the corporation tax which have done better. So this budget presents a scenario in which if you are willing to disclose undisclosed income,
foreign income, Raj.
even foreign assets, then you will not be penalized. You will not be made to pay a fee, but you will not be made to pay a penalty, but you will be made to pay a fee, which is a little higher than the normal tax rate. So the idea is to allow you, giving an opportunity of coming clean, so I think there's a lot of immunity is being granted. Decriminalization
is the running theme. Yeah,
is the running theme. So I would say that tax changes are broadly in conformity with that principle.
It is. Disinvestment seems to be coming back to the government's agenda. The total figure, along with other non-tax receipts, is 80,000 crore. Do you think this is realistically and politically also?
Well, I don't know about politically, but certainly, realistically, it is possible. We still do not know whether the Economic Service recommendation that the company's law should be amended accordingly, by which the status of a government company comes down to 26% stake. Now, if that were to happen, this 80,000 crore is actually an underestimation, because the government can really go ahead and in phases bring down the stake from 80% or 60% to gradually bring down to 26% in phases, and it will be a kind of source of revenue for not just for next year, but even for the years after that. So 80,000 crore in that sense is an underestimation. But right now, except seeing this 80,000 crore number, which is looks to me ambitious as of now, without concrete plans on paper, is probably indicative of some steps to be taken. Some maybe legislative changes will take place. Who knows?
Okay, interesting. From this year, the fiscal anchor has moved to debt to GDP, and she is guided for 55.6% compared to 56.1%. And even on fiscal deficit, it is coming down from 4.4 to 4.3. How do you read it?
Well, I see that there's a bit of a backloading of these numbers. In a sense that, please remember that last year when the entire debt anchor formula was announced, the target was that the debt to GDP ratio will be reached at 50% of GDP for the center by 2030-31. Now that still remains the target, as the finance minister announced in our budget today. But if that is the target, and which is 5 years away from here, you are 56% today, and next year you will go up only to 55%. Essentially, you have to go in for 1 percentage point or little more every year in the next 5 years. Okay. Now, a conservative and a cautious government would have probably grabbed this current opportunity and seeing that let me do the hard work first, and then gradually move to 50% by the final year. So I think a little bit of backloading has happened, which is not very risky, but I would still commend the government for at least stayed on the path of fiscal prudence and transparency.
The 16th Finance Commission report, along with the action taken report, was also tabled in Parliament today. The vertical sharing stays at 41%. But the grant to states for FY26 have come down to 1.4 trillion, which is lower compared to last year. How do you read it?
I think this is in line with, once again, my favorite theme of how economic survey is being reflected in this budget time and again. Economic survey did talk about how the states are not necessarily always playing ball in terms of reducing their debt, and there have been also very learned commentaries which Business Standard has also carried,
Yes.
which says that it is the states which must pick up
the
ball.
gauntlet. Yep.
And so I think here also the 16th Finance Commission has set some new norms by which, while the tax devolution, if you look at the number, that goes up, but the grants comes down.
Okay.
So a little bit of squeeze on the states. Under what manner, under what formula has been used, and that has led to this decline in the state's share of the grants. One has to look at it. But if you look at the central sector schemes and the centrally sponsored schemes, everywhere the states have got
burden
has shifted to the states.
That's interesting. Thank you, AKB, for such an enlightening discussion. And thank
you.
you, viewers. Back to you, Ankur.
Thank you, Shailesh. So this is a budget that largely emphasizes continuity with fiscal prudence, a renewed focus on services, and incremental steps to improve ease of living. Thank you for joining us. For more on the Union Budget, keep reading business-standard.com.